Our today's video will be on reducing your tax liabilities by taking advantage of tax credits. Reducing your tax liability is a common financial goal for many individuals and businesses. It's important to note that tax laws can vary significantly depending on your location, business, and individual circumstances. So as a disclaimer, this is not an individualized tax advice. Please consult with a qualified tax professional, such as Addendum CPA or other qualified tax professional, to ensure you're taking advantage of all appropriate deductions and credits. Here are some of the strategies to consider in reducing your tax bill by taking advantage of tax credit. 1. Earned Income Tax Credit, EITC. The EITC helps low to moderate income workers and families get a tax break. If you qualify, you can use the credit to reduce the taxes you owe and maybe increase your refund. You may claim the EITC if your income is low to moderate. Also, the amount of your credit may change if you have children, dependents, are disabled, or meet other criteria. Military and clergy should review the IRS special EITC rules because using this credit may affect other government benefits. To qualify for the EITC, you must have worked and earned income under $59,187. Have investment income below the required threshold, e.g., $10,300 for the 2022 tax year. Have a valid Social Security number by the due date of your return, including extensions. Be a U.S. citizen or a resident alien all year. Not file Form 2555, Foreign Earned Income. Meet certain rules if you are separated from your spouse and not filing a joint tax return. The EITC has special qualifying rules for military members, clergy members, taxpayers, and their relatives with disabilities. If you're unsure if you qualify for the EITC, use the IRS Qualification Assistant. To qualify for the EITC, everyone you claim on your taxes must have a valid Social Security number, SSN. To be valid, the SSN must be valid for employment, issued before the due date of the tax return you plan to claim, including extensions. For the EITC, the IRS accepts a Social Security number on a Social Security card that has the words, "Valid for work with DHS authorization" on it. For the EITC, the IRS don't accept Individual Taxpayer Identification Numbers, ITIN, Adoption Taxpayer Identification Numbers, ATIN, Social Security numbers on Social Security cards that have the words, "Not valid for employment" on them. For more information about the Social Security number rules for the EITC, see Rule 2 in Publication 596, Earned Income Credit. 2. Child Tax Credit. The Child Tax Credit helps families with qualifying children get a tax break. You may be able to claim the credit even if you don't normally file a tax return. You can claim the Child Tax Credit for each qualifying child who has a Social Security number that is valid for employment in the United States. To be a qualified child, your dependent generally must be under age 17 at the end of the year. Be your son, daughter, stepchild, eligible foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of one of these. Provide no more than half of their own financial support during the year. Have lived with you for more than half the year. Be properly claimed as your dependent on your tax return. Not file a joint return with their spouse for the tax year, or file it only to claim a refund of withheld income tax or estimated tax paid. Have been a U.S. citizen, U.S. national, or U.S. resident alien. Parents and guardians with higher incomes may be eligible to claim a partial credit. Use the IRS Interactive Tax Assistant to check if you qualify. You can claim the Child Tax Credit by entering your children and other dependents on Form 1040, U.S. Individual Income Tax Return, and attaching a completed Schedule 8812. 3. Education Credits. An education credit helps with the cost of higher education by reducing the amount of tax owed on your tax return. If the credit reduces your tax to less than zero, you may get a refund. There are 2 education credits available: the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC. Don't overlook these important credits. There are additional rules for each credit, but you must meet all three of the following for both. You, your dependent, or a third party pays qualified education expenses for higher education. An eligible student must be enrolled at an eligible educational institution. The eligible student is yourself, your spouse, or a dependent you list on your tax return. You cannot claim an education credit when someone else, such as your parents, list you as a dependent on their tax return. Your filing status is married filing separately. You already claimed or deducted another higher education benefit using the same student or same expenses. You or your spouse were a non-resident alien for any part of the year and did not choose to be treated as a resident alien for tax purposes. There are several differences and some similarities between the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC. You can claim these two benefits on the same return, but not for the same student or the same qualified expenses. 4. Savers Credit. You may be able to take a tax credit for making eligible contributions to your IRA or employer-sponsored retirement plan. Also, you may be eligible for a credit for contributions to your Achieving a Better Life Experience ABLE account. If you're the designated beneficiary, you're eligible for the credit if you're age 18 or older, not claimed as a dependent on another person's return, and not a student. You were a student if during any part of 5 calendar months of the tax year you were enrolled as a full-time student at a school or took a full-time on-farm training course given by a school or a state, county, or local government agency. A school includes technical, trade, and mechanical schools. It does not include on-the-job training courses, correspondence schools, or schools offering courses only through the internet. Depending on your adjusted gross income reported on your Form 1040 series return, the amount of the credit is 50%, 20%, or 10% off. Contributions you make to a traditional or Roth IRA. Elective salary deferral contributions to a 401k, 403b, governmental 457b, SARSEP, or simple plan. Voluntary after-tax employee contributions made to a qualified retirement plan, including the Federal Thrift Savings Plan, or 403b plan. Contributions to a 501c18d plan, or contributions made to an ABLE account for which you are the designated beneficiary, beginning in 2018. Rollover contributions do not qualify for the credit. Also, your eligible contributions may be reduced by any recent distributions you received from a retirement plan or IRA, or from an ABLE account. 5. Energy efficiency credits. If you make qualified energy-efficient improvements to your home after January 1, 2023, you may qualify for a tax credit up to $3,200. You can claim the credit for improvements made through 2032. Beginning January 1, 2023, the credit equals 30% of certain qualified expenses, including qualified energy efficiency improvements installed during the year, residential energy property expenses, home energy audits. You may claim the energy-efficient home improvement credit for improvements to your main home. Your main home is generally where you live most of the time. For the energy efficiency home improvement credit, the home must be located in the United States. An existing home that you improve or add on to, not a new home. In most cases, the home must be your primary residence, where you live the majority of the year. You can't claim the credit if you're a landlord or other property owner who doesn't live in the home. If you use a property solely for business purposes, you can't claim the credit. If you use your home partly for business, the credit for eligible clean energy expenses is as follows. Business use up to 20%. Full credit. Business use more than 20%. Credit based on share of expenses allocable to non-business use. To qualify, home improvements must meet energy efficiency standards. They must be new systems and materials, not used. Some improvements have specific credit limits as follows. Building envelope components. Home energy audits. Residential energy property. Heat pumps, biomass stoves, and boilers. To maximize your tax savings, it's crucial to stay informed about changes in tax laws and consult with a tax professional such as Addendum CPA or other qualified tax professional to ensure you take full advantage of available tax credits. Additionally, Keep accurate records and receipts to substantiate your claims and maintain compliance with tax regulations. Have you had to use any of the above strategy before? Did you run into any issues or learn things that you wish you had known before? If so, please share them below in the comments section. If you enjoyed this video or found it useful, please give it a thumbs up and consider subscribing to our channel for more updates. Until next time, stay safe.